Hi, I'm Paul Sanger for the Finance News Network, and today I have the pleasure of speaking with Nicholas Chaplin, Director and Portfolio Manager for Seed Funds Capital. Nicholas, welcome.
Thank you, Paul. Delighted to be here.
Now, Nicholas, APRA recently released, or actually yesterday released, a discussion paper outlining proposed changes to the capital framework for banks with a focus on phasing out AT1 hybrid bonds and replacing them with more reliable forms of capital. The proposal aims to enhance financial system stability, especially during times of stress, and protect depositors. Can you provide an overview of the proposed changes to APRA's capital framework and the main objectives behind them?
Yes, they're looking at, as you've said, phasing out the additional Tier 1, which is, if you like, the middle level of capital. There's another level above it, Tier 2 capital, which is debt, and below it, of course, common equity, which is the share capital of the banks. They're looking at it because they feel that in a crisis, it has been seen, and looking particularly at Credit Suisse and perhaps some of the US banks last year, that this instrument didn't perform its job. I think it needs to be mentioned, though, that the structures of these issues offshore are very, very different, and the banking industries offshore themselves are vastly different to the banking industries in Australia. So one of the submissions that I and others made a year ago when APRA was first starting to look at this was we need to really look in the mirror at how well the regulation's gone in Australia of banking industry versus the failures that are occurring offshore. I'm sure we'll get into that. Another aspect that's very important is they felt that retail involvement in these investment products, these additional Tier 1 hybrid instruments which are listed on the Australian Stock Exchange, wasn't helpful ultimately if the government wanted to bail them out at the wrong time. So they are concerned, much like ASIC was in the past, and probably still are, that retail involvement is there. But there are very, very simple ways to deal with that without dispersing the entire hybrid market.
Gotcha. Let's get into some details. APRA has highlighted the limitations of the AT1 hybrid bonds during recent global banking turmoil, as you just touched on. Can you elaborate on the changes APRA observed with the AT1 instruments, especially during times of crisis? So what was going on?
So if you look at Credit Suisse, there was a hybrid instrument there that was meant to be bailed in, I think, a lot earlier. I think APRA is looking at the jurisdictions and saying, well, where banks have failed, Spain in 2017 with Banco Popular, not so popular, and in this case with Credit Suisse in 2023, these instruments should have kicked in earlier than they did. They ultimately did bear the brunt of that loss, and with Credit Suisse, hybrid investors indeed got zero. But the terms of those instruments dictated that they got zero. So the investors in the hybrids in that case, and they were wholesale-only investors, knew that they'd get zero in that case. They weren't actually surprised when it happened, other than perhaps that Credit Suisse went down, but they knew what the outcome was for them. I think APRA is thinking in Australia with these instruments, perhaps we need to tweak these instruments a little so that they kick in a little bit earlier as opposed to right at the end, the last minute.
Okay, and APRA is also proposing to phase out AT1 capital instruments by 2032. How does this transition plan address potential risks, particularly for investors who currently hold the AT1 instruments?
Well, we're going to see those instruments be maintained until their initial call date. Yeah. In a way, APRA has effectively almost guaranteed that optional call date to occur. It's turning these hybrids into very much more bond-like instruments with a dedicated call that they are likely to be incentivised to actually make sure they happen. Consequently, the last one is at the back end of 2031 at the moment, so that's the reason for the timing. By 2032, you can commence without AT1 instruments. We'll only have Tier 2 and equity, and they're commencing it in year 2027 because the minimum period that you can have an AT1 must be 5 years. So between now and 2032 is 8 years. However, it's unlikely that you will see new AT1 issues issued. Theoretically, you could see some, but by January of 2027, they'll only count as Tier 2. So why would you issue an expensive Tier 1 instrument if it counts as Tier 2 in 2.25 years? So I doubt we'll see any new ones going forward.
Got you. And how do the proposed changes impact large international active banks versus smaller domestic banks in terms of capital requirements?
Well, they have changed the rules here in that What they're suggesting for the larger banks, they'll replace the AT1 issues with, it's 1.5% of capital, so they'll replace that with 1.25% of additional Tier 2 or more debt going into the balance sheet to support capital, and the extra 0.25% will be common equity Tier 1. For the other banks, the standardised banks, the smaller banks, that would be all Tier 2 replacing their AT1. Now, as I've mentioned, this will increase the gearing effectively that these banks are taking on. It could have ramifications for their credit rating, which could have ramifications if they are lowered or in danger of going lower, to lifting the costs of their full balance sheet funding. That's not ideal for Australian banks going forward, particularly when foreign or competitor banks offshore that do compete for the funding available in this market with the Australian banks, they're going to get a better show.
And Big Four, let's be clear, the Big Four banks in Australia have top ratings currently.
At the moment, they are 4 of the top 7 rated banks in the world. This is bringing that into question, I suspect. And at the end of the day, APRA is really tasked with safeguarding the integrity of the Australian banking industry and safeguarding or protecting depositors. I think this has some real risk of going in the opposite direction.
Yes, let's talk a bit more about that. So APRA has cited that Australia has an unusually high proportion of retail investors holding AT1 instruments. How does this factor influence the decision to phase out AT1, and what will the impact be on these retail investors?
Well, I think retail investors will no longer be available to buy anything other than listed equity from the listed perspective. There is 1 or 2 listed senior instruments out there. Yeah. No more hybrids ultimately. Obviously it's phased out over the next 7 to 8 years, but that market, that universe is going to get materially smaller relatively rapidly. The first 2 transactions coming up for call are in the first quarter of 2025, and then we'll just continue to go from there if APRA proceeds with this. The Tier 2 instruments are all wholesale, and I don't think it would be prudent for APRA to suddenly allow for the listing of Tier 2 instruments, sub-debt, of the banks if they're concerned about bailing in retail and allowing retail to buy these instruments. Remember, Tier 2 sub-debt can still be bailed in a crisis. Yeah. So not a lot of choice there for retail. They're going to need to think about what they use that for. There is a risk now that they're being driven into riskier instruments.
And this proposed changes aims to improve banks' ability to use their capital buffers more quickly and confidently during a crisis. Could you explain how these new capital requirements will strengthen banks' resilience in stressful scenarios?
Well, it's hard to do that if I can't really see it myself, but I know that that's what APRA is saying. They're suggesting that there'll be slightly more common equity and replace Tier 1 with Tier 2, so the level of capital will be the same. But again, they're reducing the levels of capital that are available, probably in the safest banking industry in the world, bar maybe New Zealand. We have mortgage banks in this country, aside from Macquarie. We do not run investment banks as a predominant norm in Australia or indeed in New Zealand. And in fact, the New Zealand banks are generally owned by Australian banks anyway. So you have a very safe banking industry here. By changing this and taking out a diverse way of funding the capital needs of Australia. And by the way, APRA's done an excellent job of being very conservative around their application of the Basel rules here. We have very conservatively capitalised with, and also with the liquidity rules in banking here. I don't know why they're playing with it, quite frankly. If you're concerned about retail being a party to the AT1 instruments, and we should address this perhaps, Paul, there's a very simple and neat way to do that, and that is to simply introduce a minimum investment amount of $500,000 or trading amount of $500,000 and leave them listed on the ASX exchange. That basically means that sophisticated investors only can play. So it achieves the same end without weakening the Australian capital rules.
Well, you should call APRA up and put that suggestion to them pretty quick smart.
Well, they have asked for 2 months of consultation with these changes. I encourage all parties out there that have an interest in this to make a submission to them. We must also remember that the current the global international prudential capital rules dictate that AT1 is part of the banking capital universe. In doing this, APRA is going against those rules. That is not ideal, and again, I can't understand why you would want to weaken us competitively versus the rest of the world simply because you're concerned that of the type of investor base that's buying into this. Remember, these investors, these retail investors, are being allowed to buy any form of equity that they want with their superannuation. Don't worry about the risks of that. They understand equity, evidently, but you can't buy something higher ranking from a bank that has not failed in the 25 or so years that this market's been functioning in Australia. So it goes against all common sense.
I would have a gut feeling there'll be a lot of submissions going through in the coming weeks, that's for sure.
I hope to see so, and I'm encouraged by some of the other commentary that's coming out, picking up on these same themes.
Yeah. The discussion paper also mentions reducing compliance costs for banks. How do you see these proposed changes simplifying the regulatory framework, especially for the small and the mid-sized banks?
Only that in issuing Tier 1 capital or the hybrid issues, you are issuing a prospectus, you're paying lawyers for that, you're paying syndicate groups to do that, you're paying brokers to get those distributed. Those costs will be lower if you're issuing in the wholesale market only, which would be a Tier 2 market. However, in a crisis, Tier 2 is not going to cut it. You're not going to be able to come in if you need a couple of $1 billion and save the bank with $2 billion of subordinated debt. You're going to need hard equity to do that. You could have resolved it very quickly by converting the Tier 1 into equity, which is what APRA is concerned about, converting retail into a gone conclusion on equity with the AT1 instruments. But we need to think about the likelihood of that actually happening, Paul. And the strength of the banking industry in Australia is being ignored by the regulator, which amazes me because they've brought about that strength. So the likelihood of the need to bail in people through AT1 is a very, very key point in this debate.
Now, you touched on this earlier, but I think it's worth going into a bit more detail. The transition period is set to begin in January 2027 with full implementation by 2032. Why has APRA chosen this timeline, and what are some of the key milestones in this transition process?
Well, first of all, it allows people to get used to the idea that the AT1 is going to phase out. Even though they're stating that they'll start the transition in January of 2027, I think it precludes really any practical new issuance, even for refinancing of additional Tier 1 or hybrid issues. So those two deals that are due in March and April of 2025, ANZ and CBA, both of them combined are worth about $2.5 billion. I would expect now that they will be let go and replaced with most likely Tier 2 issuance, potentially with some retained earnings and dividend reinvestment plans, etc. in equity. And that trend will continue on as we go. So you're getting the market used to the fact that that's going to happen. It's going to make Tier 1 hybrids now perhaps more attractive to the market because there's going to be less of them down the track available, so people will get in to get hold of these things while they last. Yeah. And again, the last one coming up is at the end of 2031. I think it's a Westpac issue. And 2032 being, that's it. From that year on, there'll be no more phasing them out. I can't see the economic incentive of issuing a new one now for it only to count as Tier 2 in 2.25 years. Consequently, this is APRA preparing people for another way of going forward with capital. We'll see how practical that is.
No, exactly. And what's going to be the broader implications of these proposed changes on the Australian financial system and its stability during stress?
I actually think it's going to do a lot to create instability, or more instability, or less stability, if I can put it that way. To not have that layer of capital available to protect the shareholders of the banks, let's say the lifeblood of those banks when the crisis may come, you can only go to those shareholders so many times at a significant discount to raise capital to save a bank if you do get into trouble. So if you do believe this banking industry may deliver a failure at some point in the future, be it an economic driven one or a geopolitical driven one or some other event, you've got to then assume that there is value in having that middle layer of capital that you can convert into equity at that point. Again, we've mentioned solutions potentially for precluding retail from being involved in that without shutting this down. and making the Australian industry weaker compared to everyone else. But I think ultimately I cannot necessarily see this as being an enhancement. I see it as being a degrading point on the quality of safety net in Australian banking. And after all, the prudential regulator is here for the safety of depositors. This is making the depositor's position weaker, ultimately.
So just my take on this listening to you for the last sort of 10 minutes, this decision seems to me that it's come a little bit out of left field. I'm keen to hear your thoughts. What's been the reaction today in today's market?
Well, firstly, you're right. It has come out of left field, Paul. It was never an option in the original paper a year ago. I think we touched on that earlier. The reaction has been initially passive. People was digesting it and taking it in. That was yesterday afternoon. But this morning, people have woken up with, I think, a little bit of a different view, and I've seen some commentaries already suggesting that this is really the wrong direction and needs to be questioned with APRA. I'm concerned that a lot of the submissions that they received were perhaps not understanding the ramifications of what they were contemplating. And they've now gone and done something that they didn't even contemplate in the first paper. So they've almost ignored the initial paper and said, well, actually, let's just take it out. This is completely new, and put a system in place that is operated nowhere else in the world, where the safety net in other jurisdictions is better than what you have in Australia. All for, it seems, the case of taking out a certain type of investor, which doesn't make a lot of sense to me, particularly when you consider the work that APRA had done since its inception in 1998, when it replaced the RBA as the prudential regulator, to create one of the safest and well-run banking industries globally. To undermine that now with a decision like this, which doesn't seem well thought out, I'm pleased to see that others are picking up on it. So what I would now encourage are more submissions by the market. Do think about the ramifications of this. And I'm coming at this, by the way, as a fund manager, I'm coming at it from the angle of, if you take out listed hybrids, those investors that want to maintain a piece of fixed income in their portfolios, it's beneficial to me as a fund manager to then be available to place them into even Tier 2 instruments. Tier 2 instruments are not listed. You can only get these through a fund manager, or if you are a wholesale investor that has those touch points with brokers. So it would be highly beneficial for me to come out in support of what APRA is doing. But I don't support things that are undermining the strength of something that has been exceptional for a quarter of a century. And I believe that's what these proposals will do. So I'm not in support of those, and I'm grateful for other people seeing that as well.
Well, Nick, it's been an absolute pleasure having you in here today, sharing your thoughts. I've got a feeling this is chapter one of multiple chapters. We'll be discussing this over the coming weeks and months, and I look forward to having the next conversation and hopefully get a bit more insight on the reaction, which, as you said, I think is people are now reflecting on what has been said, and I think more thoughts and views are going to be coming out in the ensuing days and weeks.
Absolutely. Thank you very much, Paul.
Absolute pleasure.